Hello, friends. Welcome back to the Kuderna podcast. I'm Bryan Kuderna. In today's episode, I'll be presenting you a financial physical. So I know you probably hear a lot of comparisons between health and wealth, how to take care of your overall well-being. And what I found over time, and I get this feedback a lot from doctors who are actually clients of mine, is that when you're in the medical community, there's so much that's based on science. And you can tell exactly where you stand, kind of if you're in good health or poor health, by a number of very popular benchmarks. Now, in the financial world, unfortunately, we don't have such a scientific approach that everybody can just go out there and just say, okay, I am in good financial shape or I'm not in good financial shape. And that's a question I get from my clients, I would say 9 meetings out of 10, in which after we go through a full fact finder or planning meeting, they look at me and they say, hey, Bri, are we in good shape here? And it's as if after all those years of doing whatever planning or whatever it is that got them to where they are today, they're not really sure if they're on the right track or not. So with all of that in mind, what I'm going to do in today's episode, it'll just be a brief monologue, but I think a very effective one. So you don't have to worry. I'm going to try not to go on and on, but I'm going to give you a financial checkup in which you can kind of self-diagnose and see how you're doing right now. Now, these are 10 benchmarks or guidelines that I've come up with in my financial planning practice over the past 15 years that, again, I can't say that they're scientific. I do have to put that disclaimer there. There's no governing body, there's no CDC or NIH or American Heart Association or anyone saying that, hey, this is the way it needs to be and it's conclusive. These are rather guidelines that I think could be widely accepted and that I personally have found very effective in my own financial planning and in that of all of my clients over the past couple of decades. Okay. So please stay tuned. If you have questions, again, you can reach out via social media. You can send emails anytime to thekudernapodcast@gmail.com. That's where we get a lot of our guests and everything on the show. So let's keep the interaction going. And that's where so many of these topics come from, is from you guys, my listeners and viewers. And with that in mind, I just want to remind everyone, please, wherever you're listening or watching, do subscribe, leave us a review, go tell a friend, and that's how we keep on growing this and share more and more financial education, business education, and all things guided towards what I define wealth as, which is its old school meaning, a state of well-being. And that fits perfectly in today's monologue, in which we'll talk about health and wealth and how you can tie the two together perfectly and make finance simple. That's what we're going to do today.
Is going to require work and time and sweat and toil.
If money wasn't an issue, what would I be doing?
Don't worry about it. You'll figure it out.
Change is the only constant.
The Kuderna Podcast.
All right, so without further ado, as we dive into this physical, and I do want you to approach this questionnaire or this 10-point checkup just like you would an annual physical. I tell all my clients we need to have annual reviews. We got to hold each other accountable. We got to stay on the right track. This is a great way for you, no matter what stage of the game you're at, to say, okay, let me just run through these quick 10 questions and see how we're doing. And you could actually score yourself. And that way you can begin to determine, am I in good standing? Am I ahead of the pack, or am I kind of falling behind? And naturally, what we'll say, just like if we go back to school, if you score over a 70, I would say that you're passing, you're doing well. But if you can score a 90 or 100, I would say you're probably in very good financial shape. You probably are comfortable. You're probably not worrying that much about your money. And if we're below 70, if we kind of get that quote unquote failing grade, then we need to revisit some of these things, whether it be on your own and really kind of diving into it, or seeking professional help, which is what I always counsel people to do. We're out there to help. You always want to work with a CFP, a certified financial planner, and that's where you can likely get the best advice for your personal situation. But again, without further ado, let's get right into it. So the first question on our 10-question quiz, do you have an emergency fund? Okay. And just to elaborate on that point of do you have an emergency fund, I would qualify that as 6 months of your expenses readily available in cash. And now you might be asking, well, what exactly is cash? What does that mean? Like money under the mattress, or what is that? Cash equivalents are things that are readily available and we know exactly what that value is and it's guaranteed to be that value. That would be a checking account. That would be a savings account, a money market account, maybe actual cash if you're hoarding cash up in your safe at your house. All right, all of those things are cash equivalents. You can get at them very easily. We can have them instantly, just a couple clicks of the button on our app on our phone from online banking, and we know that we can use that money. Now, an emergency fund is exactly what it sounds like. If life throws us a curveball, we've got to fix the roof on the house. You know, the engine in our car just went. One of our kids got sick and we have some unexpected medical bills. All those sort of things we want to be able to pull from cash, or at least have the option to, even if we don't. And the reason that I say that is, of course, the American way. All right, if life throws us that curveball and we don't have cash ready to go, the American way is just to whip out the credit card, charge it, put it on plastic. And now all of a sudden we've added something into the liability column that perhaps we're not ready for. This was an unexpected, now new debt that we have. And usually when you incur debt and not on your own terms, it's bad debt. And that's often high interest debt, such as the credit card or some other financing that is not ideal. Okay. So your emergency fund is just that. But I also like to call it sometimes an opportunity fund. Okay. Forget about the curveballs and all that stuff that life is going to throw us. But let's say you get a great opportunity. You want to go into an investment or a real estate project or what have you, with a partner of yours. Maybe you saw a great deal on, whatever it is that you're trying to buy, a piece of jewelry for a big life event. Maybe it's a new car. Things like that, they always say cash is king. And the reason being is that the first person that can get there with cash in hand is usually going to be the prime customer. And so that's where it can become an opportunity fund as well. And again, I define that as 6 months of your expenses. So if you just run out of budget, which you should often do, you tally up, 6 months of those average expenses, that's what should be in cash. If we go above that, maybe it's because we're planning for a big project or expenditure in the next year or so. Okay, but we don't want to hoard cash forever. All right, it's better that than having too little. But again, we want to get our money working for us, which we'll get into in a minute. So number one, do you have an emergency fund? And again, I like to see that to be 6 months expenses. All right, second question on our quiz today. Do you exceed the median earnings of your age group? Okay, and this is from the Bureau of Labor Statistics. All right, so those who are between the ages of 25 and 34 have a median earnings of $54,000. Those between 35 and 44 have a median earnings of $65,150. People between the ages of 45 and 54 are at $63,750. And those between ages 55 and 64 have a median earnings of $62,200. Again, that is the latest data from the Bureau of Labor Statistics. And so median earnings, that's a great gauge to see, okay, what stage of life am I at? What is middle America, right? The median population that looks like me at my age category, what are they earning? If I'm below that, all right, that's nothing to panic about, but that means that maybe I need to pick up some ground, whether that be picking up a side hustle, another gig, looking for a new job, perhaps kind of tuning up the resume. Or if you say, no, I love what I do, I just happen to be below that benchmark, then our lifestyle and our financial plan has to be in sync with that. Okay, obviously we can't live as if we made $300,000 a year if we're making $50,000 a year. Okay, so that's a good one to just check out. How are you doing versus your peers from an earnings standpoint? If you have to rewind real quick to get those numbers, go ahead, and I'll also put a link to that in today's show notes. Third question in today's financial physical. Do you have an investment portfolio with monthly automatic contributions? Okay. I always tell clients there's rich people that work really hard for their money, and then there's wealthy people who work really hard and then their money makes a lot of money. That's the category we want to be in, is in that wealthy side. Okay. And where that comes about is when we start to invest, when we get our money working for us in the markets, in a portfolio where we have a long-term vision and we have the opportunity for that money to grow. Okay. And this is definitely where I would suggest some professional help as you customize a portfolio that fits your objectives, your time horizon, and your risk tolerance. Okay. Once you've done that, you usually don't want to just let it sit there and say, okay, how's it going to do over the next 10 years? No, the best thing we can do is add to that. And I like drawing things down to shorter and shorter modes rather than saying, okay, my goal for the year is X. Let's put away that much money. Let's bring that down to a monthly basis. I find that to be most effective so that every month you say, okay, this is our number. This is our target we want to try and hit. And if we can put that on an auto draft, that takes all the guesswork out of the equation. So we can just kind of set it and forget it, begin to live kind of within our new budget, and pay yourself first. Know that automatically every month we have the right amount of money going into our portfolio, building and growing for the future. And then we can go ahead and live life and enjoy ourselves and know that we already hit our mark, that we hit our goal for the month. Okay. So again, number 3 is, do you have an investment portfolio? And furthermore, with automatic monthly deposits. Okay. Question number 4. Do you cover at least 50% of your compensation with disability insurance? Okay. I always tell people protection first. And in that vein, your income, okay, is the engine that makes all things run, right? Without our income, while we're in this accumulation phase of our career, so call it from 22 to 65, all right, that's kind of our average career horizon. Within those years, that is the gigantic accumulation phase where we're doing it all. We're living, we're having fun, we're providing for our family, but we're also saving for the near term and the long term. That's when we have so much responsibility and we're a producer in the economy. But again, all of that is based on our ability to go to work and generate an income. If we ever lose that ability, we ever get sick, we get injured, we can no longer go to work and do whatever it is that we do. Now, unfortunately, that financial plan can become like a house of cards where it implodes on itself and it's like the worst case scenario. And unfortunately, I've seen this with folks where it's that double whammy. We get disabled, our health bills are going up, our mental health takes a huge hit as we're no longer doing our routine of what we do every day. We're a strain perhaps on our household. And to make everything worse, we just watched our income either get, completely eliminated or perhaps, drastically cut. And that is one of the hardest things I've ever seen people have to go through, is living with a disability and a simultaneous loss in income. So again, the best way to protect against that, making sure that you've maximized the income protection against your current earnings, and ideally through what's called own occupation disability insurance, meaning that whatever your job is, your specialty, be it an attorney, be it a surgeon, an architect, whatever it could be, that skill set has been protected. So if you lose those abilities, we can replace that paycheck. Okay. Again, best done through individual own occupation disability insurance. And if we can go closer and closer to protecting the full income, great. But again, as long as we can cover at least 50% of that, then I think you're putting yourself in a pretty good position to plan for the unexpected. Question number 5, you zero out your credit card balances every month. This is a huge one. I've seen so many people that say, well, I don't have a ton of credit card debt, but it's just always there. Every month I have $3,000, $4,000 of credit card debt. I pay my minimums. I use the card. I try and pay a little bit. and it's just this revolving debt. Guess what? You look at right now what the average credit card interest rates are, they're hovering around 20%. Okay, so again, just a simple example. If I have $10,000 of credit card debt and I pay $200 a month on that every single month, and it just sits there at 10 grand, that balance all throughout the year, all right, well, 20% interest on 10 grand, that's $2,000 a year. That means that $200 monthly payment I've made all throughout the year that I'm really trying to fight and get ahead with. Well, guess what? We start out next year with about the same $10,000 credit card balance. And that is one of the most humbling and also difficult things that we have to deal with, is when we're fighting to make a payment, but it truly feels like we're on that hamster wheel and we're not getting anywhere. I can't tell you how many times I've seen that, and the main culprit is credit cards. Now, on the flip side, if you can zero out your credit card every month, you will not pay late fees, you will not pay interest on that, and you can get all the different cash rewards, travel rewards, all those different things you hear about. And another bonus is it's one of the best things for your credit score. Okay, so it's good to have a credit card, it's good to use a credit card, but you want to zero that out every single month. If you're not, I sometimes say that's like a poison to a financial plan, where we need to really focus, all hands on deck, figure out how we can rein that credit card debt in. Number 6, you pay your vacations in full in advance. All right, kind of similar to the credit card conversation. If we can get ahead of things, we plan our vacation, our getaway with the family or friends or whoever, and we get to go on that vacation with a clear mind, knowing that our debt's been paid, we're ready to go, we can enjoy it, and when we come back, we hit the ground running. It's not some debt hanging over our head that now we have to worry about for the next 6 months. Okay, so that's important to do. We want to save up for the vacation or plan a vacation that's within our means, and ideally pay that in full before you've even gone on that vacation. Question number 7. Do you get your full workplace retirement plan employer match? So whether you get a 401k, a 403b, a thrift savings plan, these are all different tax codes depending on the type of employer that you work for. But these are all called qualified retirement plans that you have through work. Many plans today will offer a company match or employer match. You especially see this as defined benefit pensions, which is what people used to plan for with retirement, have really gone by the wayside, and they've been replaced with these defined contribution plans, okay, where, as the name implies, we know what we're putting in there throughout our career, but what we get on the back end when we retire is a bit of an unknown, because that's going to be predicated on how our investments did throughout our career. But with all of that said, let's say that you make $100,000 a year, and your company says, we offer a dollar for dollar 3% match on your 401k. Well, what that means is if you put in 3% of your pay, or $3,000, your company matches that, and they put in $3,000 of their money into your retirement plan. There is nowhere else in the world of finance that you can get a guaranteed return on your money like that. So obviously, sometimes it's nicknamed free money, all right, from the employer. You do not want to miss out on that, okay? Now, just a caveat to that, if you have other issues you're dealing with, you're saving up for some big expense, for a wedding, a house, a new car, etc., you have that credit card debt we talked about earlier. There can be some things that supersede that take precedence, where we have to address that first. But assuming that we have a good foundation, we're in good financial shape, and we have the ability to defer income, we want to at least get that employer match. I don't want to say it's a no-brainer, but it's close. Okay, we should be capitalizing on that. And then number 8 on our financial physical today, do you own a blend of term life insurance and whole life insurance? Okay, we could do a whole nother episode on this topic, but I encourage people to cover what's called your human life value. Your human life value is the economic value based on your income and your age. so that if, God forbid, something happened to you today, you could continue to provide for your loved ones or for your business as if you continued to work your career. Okay? Again, it's not a science, it's not a perfect figure, but if you ever look at with your financial advisor or your insurance planner, your human life value, you should at least know what that looks like, have a general idea so that you can say, okay, I have enough life insurance or I do not have enough life insurance to protect my loved ones if anything were to happen to me. Now, when you look at human life value, there's a number of ways to satisfy that. Perhaps you get a small group term policy through your office or your employer. Maybe you just have some classic individual term life insurance for 20-year or 30-year, so that, heaven forbid, we were in that, typically about 1% of folks that pass away in their working years, then we know our family's cared for. And then you also have this permanent variety, of which there's a lot of different products in that kind of domain. But the most popular, the longest standing one is what's called whole life insurance. And now this can offer a permanent death benefit that can be leveraged for estate planning or leaving a legacy, has a lot of very unique tax advantages to it. And you also build a sort of equity within that plan called a cash value that throughout your life or in retirement, you can actually draw on that as another source of capital. Okay, so you get both a living value and then a family value, if you will. And so if we see a blend there, that can, again, address the near term via the term insurance and the whole life death benefit, but also the long term for any retirement and estate planning goals. Number 9, do you have a will? Okay, especially if you have a family or a business. This is important. Your will, which is probably the foundation of your estate planning, that's almost a playbook for your entire estate, right? Your whole financial picture, your assets, even your family, of what would happen if you were not here or if you were incapacitated. That's what the will can start to address. Again, I know it's not a very fun topic to talk about, but these are the things, if you sit down with your estate attorney, you have those conversations, you answer some of those hard questions, get it down on paper, and then you can walk away and move on with life knowing that if any of these unexpected events happen, or eventually whenever our time is up, that we can continue to have the impact we want here in the world on our family, our business, our philanthropic goals. All of these things can be addressed just the way that we want. And they're not subject to this infighting amongst family and everybody else. All right, that was number 9. Do you have a will? Number 10, your net worth increases each year. Okay, so I use a tool for all of my clients called the Living Balance Sheet that aggregates all of their financial data. There's a lot of similar calculators or platforms that you can use out there, or even if you just do it old school on a piece of paper every year or keep your Excel spreadsheet. It's a good thing just to kind of track score of how you're doing each year. And ideally, if you're able to live life, enjoy yourself, cover all of your bills, and then watch that bottom line increase each year, then you're trending in the right direction. Okay, that's an easy one. Is your net worth increasing each year? That was your 10 questions, guys. All right, 10 benchmarks, 10 quizzes, if you will. You can just run through those again, answer them. I'll put them all in the show notes so you have them. And then you can score, okay, what was your final score? 7 out of 10, maybe 10 out of 10, and see how you're doing. And now you have a frame of reference. You can take what often sounds so complex in the world of finance, simplify it, boil it all down to just 10 quick, easy benchmarks and determine if you're passing or failing your financial physical. And then last but not least, of course, I have to throw in a bonus question. So this is your chance for extra credit, just like when we go back to school. Extra credit. Does your retirement plan contain both pre-tax and Roth allocations? All right, back in the day, the only option was pre-tax contributions. We were able to defer our income, but remember, that's a tax deferral, not a tax savings. Okay, it's essentially kicking the can down the road. I don't pay income taxes on what I defer in this current year, but then that money inside my 401k or my IRA grows tax deferred the rest of my life until I begin to withdraw it. Then once I make those distributions, they come out fully taxable at whatever the income tax rates might be 10, 20, 30, 40 years from today when you begin those distributions. On the flip side, you have a Roth option, which is almost the exact opposite. You swallow your medicine today, we pay the income taxes on that amount of money that we wish to put in the Roth 401k, the Roth IRA, the Roth 403b. And then once it's in there, it actually grows tax-free. And if we use it correctly, we wait until we're at least 59 and a half, or we've had that Roth account for at least 5 years. We satisfy both of those. Now we're in retirement and we begin to withdraw that money. Then both our contributions and all of our earnings in interest can be taken out tax-free. Okay, so not only do you want to diversify your assets in your portfolio, you also want to diversify your tax bill. We don't know what the economy and what the government's going to look like decades from now. So if we're able to get a little bit of a blend there of taxable, tax deferred, and tax free, now when we retire, we can start to withdraw from those accounts on our terms and also use, what we call tax arbitrage as you start to withdraw, from these various buckets. So that was your extra credit question, guys. Do you have a mix of pre-tax and Roth allocations in your retirement plans? Now, keep in mind, some of these benchmarks, again, they're meant to be a guideline. They can vary from person to person, particularly depending on, what stage of life you might be in. For instance, someone that's right on the brink of retirement, disability insurance, as they've accumulated most of their wealth over the past 30 years, it may no longer be as important for someone who's, say, in their 20s or 30s and just getting going and have a very long horizon of earning and accumulating wealth and need to protect that. Conversely, someone that's in their early 20s, single, no kids, just getting started, maybe drafting a will or complex estate plan isn't exactly top of mind for them. So you use this quiz. Again, it's adaptable, it's moldable depending on what stage of life you're at, but it can serve as an assessment to self-diagnose and use it year over year and see what your score is. And hopefully you're getting closer and closer to 100. And then you know that all in all, you're in pretty good financial standing. So that was it. That was your 10-question quiz with a bonus thrown in there to try and help you guys out. And again, all of this, if you've listened to prior talks anywhere that I've spoken, you often hear about my 4-step financial planning process: protection first, build liquidity, address your debts, and then grow. And this 10-question quiz kind of fits in that same vein, in that same philosophy. So get familiar with it. And then maybe once a year, perhaps it's your birthday, maybe it's in the new year, pick a date. Hold yourself accountable to a financial physical, just like you would go for a health checkup each year. Everybody would recommend that. We have benchmarks. What should be your blood pressure? What should be your BMI? So on and so forth. Now you have something from a financial standpoint to see how you're doing with your money. So again, guys, thank you for tuning in. I'm Bryan Kuderna. This is the Kuderna Podcast. Again, please leave a review, tell a friend, spread the good word, and we will see you next time.
This podcast is intended for the general public and for informational purposes only. The show does not provide any recommendations or investment advice regarding any specific account type, service, strategy, or product, or to otherwise act in any fiduciary or other capacity. Please contact a financial professional for guidance and information that is specific to your situation. Bryan Kuderna does not provide tax or legal advice. Please contact your accountant or legal advisor to discuss your situation. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Kuderna Financial Team, and opinions stated are their own. All investments contain risk and may lose value. Past performance is not a guarantee of future results. References to specific securities, asset classes, and financial markets are for illustrative purposes only and do not constitute a solicitation, offer, or recommendation to purchase or sell a security. Bryan Kuderna is a registered representative and financial advisor of Park Avenue Securities, LLC, PAS. OSJ 300 Broadacres Drive, Suite 175, Bloomfield, New Jersey 07003. Phone number 973-244-4420. Securities products and advisory services offered through PAS, member FINRA SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. PAS is a wholly owned subsidiary of Guardian. Kuderna Financial Team is not an affiliate or subsidiary of PAS or Guardian. California Insurance License Number 0K04194.